Good morning. I'm Tim Nyland, and today we are reintroducing the earnings certain Admiral Core 30 stock portfolio for 2021. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. This is the third webinar in our new 2021 ECP family series of equity model portfolios. You can see that I've highlighted the first two webinars on the screen, circled in red. The first webinar that we did was the earnings certain family of equity model portfolios, how it all got started, as a review of the construction process. And then we took a deep dive into the 75 stock core model portfolio. Today, we're going to go ahead and build on those concepts that we discussed over the past 2 weeks. If you'd like to do the kind of analysis you're going to see in this video, then you'll need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the research system. Today, I'll be using Advisor Tools to showcase some new sector allocation reporting capabilities and the Zacks research system with composites to look at the variability in some of the equity models, as well as the valuation and profitability trends of the equity models, including some of the individual members. So let's go ahead and get started. 6 key points to remember as a follow-up from last week's webinar. I'm not going to go through all 6. What I am going to do is review the first one. The earnings certain Admiral 30 stock portfolio, which from this point forward, I'm going to try to simply refer to as the 30 stock portfolio, is a subset of the earnings certain core 75 stock portfolio. Okay, so add this to the distillation process where we start with the standard industrial portfolio of 400 stocks. We then move through SIC, we move through GROW, 200 stocks each. We distill the top 75 earnings stable names into the earnings certain core 75, and then we take the 45 stocks that were subject to any sort of reopening phenomenon during COVID out, and the remaining 30 stocks are what you get with the Admiral 30 stock portfolio. This was a research project that actually started in 2015, and I attempted at that point to pick 30 stocks that I thought would actually sustain a U.S. economic shutdown. And as COVID began running rampant in early 2020. I was actually able to wrap up my research in about March timeframe last year, and I had 20 of the 30 stocks nailed and was able to finish my project and publish the Admiral 30 stock portfolio. And so that is what we are going to review today. Again, remember that with the earnings certain family of portfolios in core, we don't hold financials, energy, real estate, utility, commodities, precious metals, any other economically sensitive names. And we use tilts to expose ourselves to companies like the mega cap tech group, Apple, Facebook, Microsoft, Netflix, Amazon, Google. If you want Tesla, if you want IPOs, pot stocks, whatever, the appropriate place for that is in tilts, not in core. So the idea is that we manage our long-term macro tilts and short-term tactical tilts to gain exposure to beta and upside capture. And you'll see that'll become very evident here in just a few minutes. Okay, so we'll go ahead and get started by looking at the S&P 500 composite. A little bit of a review from last week, but not much. Remember that it's high volatility in terms of price, low earnings stability in terms of the earnings and the manner in which the S&P 500 itself moves through economic cycles. And that can be seen here with our FY1, our FY2, and our FY3 consensus estimates coming in from our estimate contributors here at Zacks. And you can see that for FY1, we're actually projected to go up 33%, and then that growth is going to taper down to 12% and 11%. So again, just speaking to that volatility in the underlying earnings. If you're benchmarked to the S&P 500 and you're actually doing closet indexing with your own portfolios or client portfolios, then you're subjecting your clients' assets to these large drawdowns as these earnings go into troughs through recessions and other black swan events. So the idea is when we look at the actual growth that the S&P experiences over 25 years, because it gets dragged through these economic cycles, it's actually fairly low relative to the earnings certain family. So we're looking at a 7% annual EPS growth over 25 years. And again, I'm looking at the research system here. I just put the valuation model up and literally just clicked on the least squares trend rate for a 25-year chart, and it'll actually model that for you very easily. You can see the 7.02 least squares growth rate. So that's 7.02% annualized growth in earnings for the underlying S&P 500 for the past 25 years. Keep in mind, this is a composite, so this is membership as of today, okay? And if you were to mirror this over the index, you wouldn't believe how the mirror image is so close. So keep in mind that we use composites in the research system, and everyone uses composites for this type of analytic work. We look at information today. We draw historical conclusions from it by looking at history in order to basically attempt to forecast where we're headed into the future, which is what we're doing with the estimates. So we keep everything apples to apples by using composites. Keep in mind now that we're looking at the ECP Core 75 stock portfolio. The idea here is that it's low volatility, and you can see nowhere near as much drawdown in terms of price. And then that high EPS stability is that's what's buffering us and providing that protection. Here you can see the contribution of those 45 names here during COVID that were subject to that reopening phenomenon that I actually removed from the ECP Core 75 stock portfolio to arrive at the Admiral portfolio. You can also see that we've got that reopening phenomenon playing out right now. We've got a growth rate that's bumped up to 12%. It's going to moderate back down to about 8% off of a little bit higher base here in 2021, and then we'll normalize out to about 11%. And you can see that when we actually snap that 25-year least squares trend rate to growth on the Core 75 stock portfolio. You can see that over the past 25 years, this portfolio's earnings have underlying grown at about 11.9%. Okay, so you can see that trajectory is much, much more stable and a much steeper growth rate relative to the S&P 500, clocking in at roughly 7% versus about 11.9% for the earnings certain 75 stock portfolio. So here's where you can start seeing a little bit of the difference with the 30 stock Admiral. Again, low volatility, just like the 75 stock portfolio. This portfolio literally rips through every recession really unscathed. I mean, these are the 30 best of the best companies. And you can see they actually pulled forward growth during COVID. So they actually had a little bit of a growth acceleration. And you can see that as we're now rolling into 2021, we're experiencing some of that base effect because we're getting a little bit of a lag in growth here in 2021, which is very, very uncharacteristic, I should say, of an earnings certain portfolio. But again, these companies performed so well during COVID that they actually pulled forward some of that growth. So not a big deal, but what you're going to see is you're going to see that trajectory begin to increase where we get back to that normalized growth rate of 11%. So we go from 5% to 7% to 11%. And if you recall throughout some of my webinars over the past several weeks, as companies have reported, there's been a lot of noise in our estimates. And now that we're obviously more or less mid-quarter in terms of a 3-6-9-12 reporting schedule, that these numbers, the noise is now gone and they're solid. So at any rate, the 30 stock portfolio has a 25-year annualized EPS growth rate of 12.2%. Okay, and you can see what that looks like here. So again, just going to the valuation model, clicking on this least squares button for a 25-year trend or for a 25-year history, it'll model that least squares growth rate for you. Okay, so just to wrap up the summary characteristics, the S&P 500, right, high volatility in terms of price volatility, has a beta of 1, has very low earning stability relative to the earnings certain family, has annualized EPS growth rates over the past 25 years of 7% annually. Its EPS growth rate for FY1, FY2, FY3 over here, I'll comment on this just a minute, but let's go through the 75 and the 30. So the volatility on the 75 is low. The 30 has the lowest volatility, right? We saw that line was even straighter. The beta for the Core 75 is 0.81. The beta for the Admiral 30 is even lower, so even more defensive, more protection on the downside. The EPS stability, again, for the S&P 500 was low. It's high EPS stability for the 75 stock portfolio, and it's even higher for the Admiral 30. As a matter of fact, we actually grew earnings, which is uncharacteristic, at a higher rate through COVID when the economy was shut down, if you can believe that. That's the whole point of the portfolio. Annualized EPS growth rate over the past 25 years, 7%, call it 12%, 12.2, close enough. Here's where things get interesting, right? This speaks to the earnings instability. So we've got an FY1 growth trajectory of 33%, tapering down to 12% in FY2, tapering down to 11% in FY3, and ultimately we will normalize out closer to that 7% 25-year growth rate, right, over time. We'll go through another cycle at some point. The growth will collapse, and then this will all normalize out to roughly 7%. And what you're seeing here with the earnings certain family is that we're getting to that normalization much faster. So in FY3, we're already going to be at 11% for both the Core 75 and the Admiral Core 30. Okay, so everything's going to normalize to 11%, but the Core Admiral 75 and the Core Admiral 30 and the Core 75, I should just call them 75 and 30. The 75 and the 30 will get there and more or less stick. There is some variability. We do see it channel between 9 and 11.5%, but there's nowhere near the variability as there is with the S&P 500. So again, when we look at composite performance, when we overlay the current members of the earnings certain Admiral portfolio with the current members of the earnings certain 75 stock portfolio, you can see that over time, with those similar growth rates, you would expect to have similar price response. Okay, and you do. So shifting our gears a little bit now to more actual performance instead of composite performance. This is where we actually take the trades and we basically simulate the real portfolio risk metrics and try to gauge the returns as much as we can. We have the actual trades all the way back to 2013. I've got a disclosure down here. So anything from 2013 prior, so 12/31 of 13 to current, I should say, we've got the actual trades. And then before that, what we're doing is we're holding that membership constant. But you can see that the turnover is very, very small. The portfolio has never wavered in terms of its management as far as the discipline that we use to build the portfolio. So the historic returns going back 15 years are representative of what we're seeing here. So I like to use a longer sample period to get us through multiple recessions. It's just important to look at how this works. Okay. So when we start talking about the Admiral 30, the first thing we need to look at is the Admiral 30 portfolio with no tilts applied. So this is literally the Admiral 30 in core. And what I want everybody to take notice is the beta, the Sharpe ratio, almost 2 times the return per unit of risk relative to the S&P 500. These are big numbers. So a beta of 0.64. Very, very defensive on the downside. Value at risk, only 4.25 versus the benchmark at about 6 1/3. Max drawdown, less than half of the S&P 500. And again, that really low annual turnover. When we start talking in terms of performance, you can see that over the 180 months of that 15-year study, we've got an excess return of about 4.5%. And we outperform in the down market months. That excess return was actually 17.77%. You can see these numbers in red. This is what we actually managed to actively with our tilts. So you can see the upmarket annual return. We had basically 123 upmarkets, and the portfolio only returned 36. The benchmark did 45. So we were negative 8.55%. And that speaks to the need to managing that beta exposure with tilts to ensure that we capture that alpha on the upside. And so that is what we do, and we'll talk about that here in just a minute. But let's take a look at all outperforming periods, right? So we outperformed in 99 of the months in core. So that's a 55% win rate. We only outperformed in 50 up markets. months, I should say. And that win rate is literally 41%. We outperformed in 49 down markets, which is literally 86%. Okay, so this is really, really good on the down market. Now let's take a look at these same risk metrics when we compare the ECP Admiral 30 with a 20% macro tilt. The 20% macro tilt was the recommendation in 2020. And how we arrive at that macro tilt is we manage our sector exposure relative to the S&P 500. We'll go into this in a little bit more depth in just a few minutes, but last year when we applied a 20% macro tilt with our 6 tilt stocks, 20% is all we needed to apply to get the technology and communication services sector up to equal weight with the S&P 500. And you can see this year, we've got a little bit of a difference playing out. So when we do that, our beta goes from 0.64 to 0.75. So we get a little bit better beta exposure. And you can see that that directly impacts our excess returns in the up markets. You can see that excess return is now negative, only negative 1.15, where it was negative 8.55 before. And you can see our win rate goes to roughly 50%. Okay, so in up market wins, we're looking at literally 61 months, or 50% of the time. Okay, so down market 79%, all market we're at 59%. So overall better. Excess return comes up to 6.97. Down market return not so good, obviously 14.28 because we've added that beta. Interestingly enough, the Sharpe ratio goes up even higher. Okay, so now we're more than double the return per unit of risk that the S&P 500 returns. Value at risk stays roughly the same. Max drawdown bumps up just a touch because we've obviously raised our beta exposure. Okay, so again, the key here, just to reiterate, managing the beta exposure with the tilts. When we move into 2021 and we look at our sector allocation, which we'll do here in just a few minutes, we need to apply a 30% macro tilt to get our sector weights in the information technology and communication services equal to the S&P 500. So for 2021, I'm basically recommending that we move from a 20% macro tilt to a 30% macro tilt for our baseline. And we're going to talk about that strategy here as we move through market cycles here in just a minute. So that's the baseline, is a 30% macro tilt. When we do that, you'll see a stark difference here. So we actually get the beta up to about 0.8. Sharpe ratio goes up even higher. Now we're at 1.38. Value at risk bumps up just a little bit. Max drawdown increases just a little bit more. We're at 33% versus 51% for the benchmark. And you can see what happens to the performance, right? So for all markets over that 180 months, it's 8.19. In up markets, which were 123, we've got an excess return of 2.61. So we go from negative 0.8, I should say negative 8.55 to a positive 2.61. And then there were 57 down months. And you can see that the excess return was 12.59%. So overall, when we start taking a look at the outperforming periods, outperformance in basically 119 months instead of 99 months, comparatively speaking, win rate of 55% bumps up to 66. Up markets from 50 to 74, we go from only a 41% win rate all the way up to a 60% win rate. Again, just by managing our exposure with those 6 tilt stocks. Okay, 49 months was the down market. We've got 45 months now. Win rate of 86% comes down to 79%, right? And that is the trade-off that we experience with managing those macro tilts. So if we do a bake-off now that we've got the earnings certain Core 75 and both the Admiral Core 30 sitting at 30% baseline level macro tilts, we can actually do a side-by-side comparison. And you can see that for the 75 stock portfolio with a 30% macro tilt, you're looking at a beta of 0.89. And when you look at the 30 stock portfolio, you're looking at a beta of 0.8. And this is where it gets interesting, right? Because the Sharpe ratio is still higher for the Admiral 30 stock portfolio, even though it has a beta of 0.8. You're still getting a Sharpe ratio that's in excess of 2 times the market. So literally 2 times the amount of return per unit of risk you're getting out of an Admiral 30 strategy, which is spectacular. You can see the value at risk is better, max drawdown is a little bit better, annual turnover is a little bit better. And when we look at excess return, 8.19% versus 7%. This is interesting here, right? Because we've got a higher beta. The upmarket return for the 75 stock portfolio with that higher beta is actually a little bit higher, but look at how much more downside protection you're getting with the 30 stock portfolio, coming in at an excess return of 12.59%. And that again speaks to that lower beta and the fact that this Admiral 30 stock portfolio is just very, very defensive on the downside. So you're pulling an excess return of 12.59 over those 57 months. So outperforming in down markets, 45 months, 79% win rate. You can see that the all market and up market number of months, the win rate is actually a little bit better, but we actually come in with a higher excess return because of that downside protection with the Admiral 30 stock portfolio. So again, it all comes back to managing that beta exposure with those tilts to ensure that we get that upside capture in those up markets. Okay. So again, just looking at composite performance, when we look at the ECP Admiral 30 stock portfolio and its membership today, how those same 30 stocks would behave through these recessionary periods, you can see exactly this trajectory. And again, we've been through this chart before many times. The S&P 500 literally giving up, a decade or more of even gains back in the great financial crisis, and it took literally over 5 years to recover. The ECP membership is obviously a lot different. The entire family behaves in this manner, and it's been managed that way. When you manage a portfolio to earning stability, these are the results that you can expect. Okay, and it's the same thing with the drawdown during the COVID era. So you can see how our existing member Admiral 30 stock portfolio has fared relative to the S&P 500 index. So much, much smaller drawdown than the S&P 500, and we're still continuing to compound on those gains. You can see the behavior is very different, right? So the Admiral portfolio would actually sit flat for a month while that rotation in the S&P 500 continued to perform, and then the Admiral literally just started taking off here the first of the year. When the S&P 500 maybe flatlined a little bit sooner than the Admiral was still moving up. So again, they don't move in total parallel all the time, but you're getting a lot of alpha picked up here in these down periods, and that continues to compound over time. So the idea here, again, is why does this work? We did this in last week's webinar, and I just wanted to mix up the stocks a little bit. I literally choose these stocks at random. Instead of using, I can't remember, I think we were using Schlumberger, and I can't remember the other one we were using last week. But at any rate, I just grabbed IBM. I think we were using Ford. So this week we're using IBM and Apache. And again, if you're holding IBM and you've held IBM since 2012, 2013, you can see this broken growth scenario just playing out, right? We don't hold broken growth stocks in core. It's just something that you just don't want to do. So when a stock breaks down, like Stericycle, I could name a lot of others that we've pulled out of the earnings certain family, you get them out of core. The idea with the earnings certain core is that you want this growth trajectory to continue. You want to be able to sleep at night and not worry about market timing your core. Okay, that's the whole idea behind core. You don't hold companies like IBM and core that are broken growth, and you can see why. Right? These earnings have just continued to trend down. They're going the wrong way, and so is the price. So if this is part of your core, your clients' portfolios are obviously being dragged through this in terms of valuation. Same thing with Apache. If you've been holding this thing since the Great Recession, you're not only dead money, you're crying, and the earnings cyclicality is just getting deeper and deeper. And you can see that even though energy has had its run, Apache is just not doing very well here. When we look at representative stocks in the earnings certain Core Admiral, that should say 30, not 25. We've got FactSet up here and Fiserv. Again, I just grabbed two stocks random. You can see how nice and straight that earnings trajectory is, and a much different scenario. So we start taking a look at some of the actual profitability metrics of the Admiral 30 stock portfolio, you can see that return on assets, this is the ability to compound return on total assets, is literally more than twice that of the S&P 500. Not just a quarter or two, not just a year or two, but literally its entire history. And when you start taking a look at a company like FactSet versus Apache, it's no wonder. Apache is just got a history of just, long-term decline. And you can see the ROA is actually negative now. FactSet sitting at literally 21 times Apache's return on assets. So the idea is, where do you want your money invested? Do you want your money invested in an Admiral type strategy, or do you want to be playing around with stocks like Apache and IBM? Well, let's look at the actual ability for these companies to compound return on the common equity, or to return this to common equity shareholders. And when we take a look at the Admiral portfolio versus the S&P 500, you can see that we're looking at literally a 50% improvement in return on equity. And again, it's not just a quarter or two, not just a year or two. This is literally throughout its history. When you take a look at FactSet versus IBM on ROE, you'd think to yourself, well, they're pretty close, right? And IBM was actually a lot higher at one point. Then you actually move to the return on total capital, which takes into account the debt structure, and you can see that IBM has taken on a ton of debt. So FactSet clearly the winner here. IBM sitting at literally a third of FactSet's ability to compound return on its total capital structure. So I'll just go back really quick, and you can see that we were sitting for return on equity at 48.42 versus IBM at 36. Again, both FactSet and IBM taking on debt, lowering the ROC down just a touch for FactSet, but really collapsing for IBM to the tune where FactSet is literally 3 times more efficient at compounding return on its total capital. And obviously, you can see the Admiral portfolio versus the S&P 500. It's about a 50% better metric. Okay. When we start talking about companies' abilities to generate free cash, you can see that the Admiral portfolio, ever since 2020, has literally been moving in the opposite direction of the average company in the S&P 500. And you can pretty much see this throughout its history. Again, still just a winning strategy in terms of this profitability metric as well. And when you compare FactSet to IBM, you can see the similar trend, right? Roughly about 50% better. In terms of the Admiral portfolio relative to the S&P 500, it's double currently. So it's not a surprise that with all this downside protection and better performance, that these Admiral stocks would trade at a valuation premium, and they do. From time to time, you can catch it at parity and actually catch it at a discount. And if you've listened to my webinars, you know that I've screamed and yelled and made it a point every time that you can catch the Admiral strategy at a discount. Right now, it's trading pretty close to parity, which is still a great bargain, if you will, for the relative safety and performance of a strategy like this. Certainly, the Admiral stocks are a little bit out of style, a little bit out of favor right now, if you will, only because everyone is chasing the value rotation and the cyclical recovery, if you will. So again, Admiral stocks really never go out of style. Investors will be back. These valuations will be bid up relative to the S&P 500. We see this play out every time we go through a recovery from a recession. It's very normal. So always has traded at a premium. Again, no surprises here. So when we take a look at the earnings certain Admiral Core 30 stock portfolio relative to its 5-year median and the S&P 500, you can see that we're trading right in line with its median valuation. Okay, so valuation's currently in line. When we start talking about the implementation of the Admiral 30 stock portfolio, again, I spoke of this in terms of moving in 2021 to a 70% baseline for core. And again, I did that because I've already skipped down to step 2 in the process, and that is where you apply that long-term tilt. So this is the 6 stocks that we use for our ECP macro tilt. That is what's going to bring the technology and communication services sector to equal weight of the S&P 500. I've done that, and the magic number is basically 30% here in step 2 right now. Okay, so if you want to take on a little bit more risk, raise the beta up a little bit higher, then obviously you're going to apply even a larger macro long-term tilt potentially, or supplement that with tactical shorter-term tilt. And so what we'll do is we'll take a look at 3 sample allocations for basically trying to optimize this through a business cycle. Last year, we started with recession preparation, right? So back in Q4 of 2019 is where I've shown the chart several times in various webinars where the 2-year was converging into the 10. Normally, when that happens, you want to take a little bit more of a defensive stance. You've got about 12 to 18 months, traditionally speaking, to prepare for some sort of a recessionary scare or recessionary event. We had no idea it was going to be COVID. And we were positioned, right? So our ECP Core Admiral strategy, we moved to that 70% baseline. We had our macro long-term core tilts at 30%, and we had no short-term exposure to the economic cycle. So we had literally gotten rid of all the financials. We got rid of the energies, the commodities, precious metal names, all that's gone. When we start coming into the recovery stage, coming out of the recession, you've got about 3 to 6 months traditionally to execute on this. This is where you're going to want to take off some of the defensive stance, back down just a touch on your macro tilts, because you want to make room for that tactical shorter-term economic cycle tilt. And this is where you're going to fold in down here in this tactical short-term. This is where you're going to fold into those stocks where we've avoided holding in core. So again, your energies, your financials, your commodity names, precious metals, those sorts of things. So the idea here is that the reason why we back down the macro long-term core tilt is because it is possible that you'll pick up some additional technology exposure, specifically amongst the semiconductor group, or maybe even some high beta tech names. So just be careful of that. So I purposely put this at 25 to draw attention to the fact that some of that tech exposure may end up in the short-term economic cycle tilt. So the idea here is when you're coming out of a recession, you see the green shoots, you want to take down some of that core and take down a little bit of that defensive position. Then when we start getting into that normalized earnings growth phase of the economic cycle, right? So you've got up to a couple of years to potentially execute on this. You're going to know when this happens, right? You're going to start seeing growth taper, like we're actually starting to see with the S&P 500 estimates for FY2 and FY3 now. Remember, we're coming off of 33% going down to 12%, 11% for FY2. So this is when you'd want to bring back the ECP Core 30 Admiral weight to roughly a 50%, bring your macro tilts back to 30, and then kind of start backing down on those tactical shorter term tilts, just to have that little bit more of a defensive stance, because we just never know, we might hit a black swan event or a bump in the road. So those are just sample allocations. Obviously, we can discuss individual circumstances or concerns that you might have. You can always reach out to me via email or give me a phone call. So what does this look like from a sector allocation perspective when we look at the Admiral 30 stock portfolio? And here I'm using Advisor Tools, and this is the new report building facility, and I'm actually looking at a sector allocation report. And so the idea is we're looking at a 30% 6-stock long-term macro tilt to basically bring that technology and communication services sector up to the S&P 500 level. And this is why, right? So this is basically the Admiral 30 stock portfolio in core with no tilts. So this is why we need to apply a 30% tilt, because our information technology weight is negative 8.2%. And we literally have no exposure to communication services, just like we have no exposure to utilities, real estate. We have one stock in financials. I've explained that. And we have no stocks in the energy sector as well. Okay. So the idea is, in the next slide, we're going to move to a 30% ECP 6-stock long-term macro tilt. We're going to bring this infotech and communication services to roughly 0, so equal weight with the S&P. And what I want everybody to pay attention to is watch the staples weight, because in core, the ECP Admiral 30 stock portfolio has a massive, massive weight in consumer staples, as you would expect with a group of stocks that is so defensive. Okay, that should not be a surprise. But watch what happens when we apply a 30% weight. We go from a 33.4% overweight in consumer staples down to only a 21% overweight. And you can see that our info tech and communication services roughly equal 0. So now what we do is we use ETFs or stocks to apply those short-term tactical tilts in energy, financials, utilities, and real estate as we see fit. Then we remove those offsetting weights from core. So it's very, very simple to just utilize a facility like this in Advisor Tools or any other platform to do this type of work. And so the idea here is, how do you become a client? The Earning Certain family of portfolios is available across the entire Advisor Tools platform, and it's also available in the research system. And we also are now offering a premium support level that is available for additional fee, but it's designed for anyone who wants to use ECP as their own methodology, and you need a premium service level to go ahead and get that started. We can answer any questions on holdings. We can talk about implementation, style analysis, help you with marketing materials, market strategy, analyze individual stocks, whatever assistance you might need. So that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave me a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm also on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or the research system, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you for watching, and I'll talk to you all next week.